Okay, welcome back everybody. So in this video we'll be discussing some of the national income accounting associated with international trade, as well as covering some of the accounting associated with international asset transfers. The thing about international trade and international accounts in general, what makes them complicated, and the reason for that is because you're dealing with multiple currencies, and that creates a level of complication that simply doesn't exist in domestic transactions. To illustrate why this is significant, consider that if I'm going to look at the price of, say, that guitar relative to that poster or that little organ, okay, what pops into your head? Well, immediately the value of those in dollars or whatever your local currency is where you're watching this, right? And then you take the ratio. But of course, in international transactions, we don't have that common denominator. And so all prices sort of take on this dual degree of separation where we have the item, its money price, and then its other money price, or its price in the other currency. And so mentally it's more difficult, and also mathematically it ends up being more difficult as well. The current preferred practice WTO practice is to utilize 3 accounts on which to record international trade. You will occasionally find older textbooks, or some commentators will speak as though there are only 2 accounts. In those cases, it will be the current and the capital. And if you see that anywhere where there's only a presentation of the current and capital account, you can assume that what we're going to call the financial account here is completely subsumed within the capital account. Okay. The 2 are similar, financial and capital, as we'll see in a minute. You can find data about these at the BEA, so the Bureau of Economic Analysis. There, for other nations besides the United States, the OECD, so the Organization for Economic Cooperation and Development, will have a lot of this data for the rest of the world. You'll also find it, a lot of basic trade data with the WTO. And interestingly enough, the CIA fact book here in the United States has a lot of good international trade data as well. Okay, BEAs really go to a lot of also the FRED site we've used in past videos, a good source of this data. Okay, so the first of those, the current account, is the one we hear about the most. The current account is a record of all international income flows. So when income flows into the United States, we refer to that as a positive on the current account, and when income flows out of the United States, we refer to that as a negative on the current account. The net balance of the current account is the trade deficit or trade surplus. So if the net value of the current account is negative, meaning that we have more income outflow than we have income inflow, then we say we have a trade deficit. If the reverse is true, we say we have a trade surplus. Now, you'll sometimes even hear people refer to trade deficits as current account deficits. Okay, so people will say the current account deficit in the United States is X. Okay, well, that just means the trade deficit. Those 2 terms are interchangeable. Current account deficit, trade deficit, they mean the same thing. Current account surplus, trade surplus, means the same thing. All right. Now, going back to what I said a moment ago about income flows. So we don't normally think of things that way, right? We think of trade deficits as goods and services, and we think of them in terms of more, say imports than exports. And of course that's correct, right? But when we think about imports, right, imports create outbound income flows, and exports create inbound income flows into or out of a nation. So for example, if the United States sells some Harley Davidsons in Europe, that creates an inbound income flow into the United States. And it's those income flows that we're measuring in the national income accounts. All right. Okay. Other examples of types of income flows here, I have remittances, right? There's a handful of others. If at the BEA site, you can actually see each of them listed very quickly. Actually, you know what? Let's go there right now. BEA.gov very quickly. So there's a tremendous amount of data about the U.S. economy available at this website, and this is our job. What we're going to do is we're going to dig straight into the raw data. You can see there's a lot of basic stuff, like here's COVID-related stuff, so on and so forth. We're going to go straight to tools and then interactive data. So as we click on that, we see a variety of things. In this video, we're interested in international data, so we're going to click on that. We're going to then click, this tells us what's here, right, as well as recent updates. You can see it's been updated within the last month, so this is very current data, which is nice. And no, we're not going to take their survey. We click on that. We get to these options. We're particularly interested in international transactions, and we're going to grab any of these would work, right, to get us what the information we're looking for here. But we're going to want to grab this just for pedagogical purposes. And then here we see indeed current account, and we have a host of lines of data. You'll notice exports, right? So then we've got goods, right? And the way this works is that each additional indentation is a subset of the previous level of indentation. So if we were to sum all the things at this level of indentation, it would sum to this one above it, general merchandise. If we were to sum everything at this level of indentation, it sums to this, right? And so on and so on. So current account transactions, we can kind of get a feel for what those look like. Again, looking down over here, just sort of the lines. Exports, these are all exports, so we can figure out what those are. Where the U.S. is exporting. We come down to imports of goods and services here. Okay, same sets of lines. So what types of things are we importing? What types of things are we exporting? See, it's quite lengthy. It includes, remember, it's not just imports and exports, but like income, right? So if I'm working abroad and I'm a U.S. citizen, I'm receiving its inbound income to the United States. So that would be compensation of employees here, line 63. If I own stock in a foreign firm and I receive dividends, portfolio investment income, right here, line 61. Okay. Then we see the capital account, very, very small for the United States. Almost, so it's even at its height, it's just under $3 billion, right? So $3 billion, you can see this is tiny compared to any line we would choose to grab basically anywhere else here. Okay. Statistical discrepancy, that is the difference. So these are supposed to sum to zero, right, for reasons that we talked about. If they don't sum to zero, then the error is made up here in the statistical discrepancy. And there are a lot of reasons why it doesn't line up. The clearest one is everything doesn't get reported accurately. Okay, so then there's also the financial account here, which I can tell we're scrolling through now. So these are the multilateral asset transfers. So direct investment assets, this would be a foreign firm builds a factory in the United States, or the reverse. This is direct investment. Portfolio investments, buying foreign stocks or foreigners buying U.S. stocks. Debt securities, so bonds and other things like this. Other investment assets, reserve assets. So we use currency in our example, right? Currency deposits, line 87 here, sitting on the financial accounts. This would be foreign holdings of U.S. currency or U.S. holdings of foreign currency, depending upon which specific notation we're looking at. Okay. All right, so that's sort of flavor of this. This is BEA, so it's really cool. I strongly encourage you to play around with this a little bit. So for example, if we wanted to download this data, we can download it. If we want to share it to our Facebook page or whatever, we can do that. If we want to print this up, we can do that. If we want to modify it, if this isn't the right years, if we want to say the last, 7 years, we want to make the data annual, we can just have a few of the lines or all of them, right? Okay, you see the data tables change. So it's pretty intuitive to use, and it's pretty slick. So check it out. Okay, so some definitions. Exports are goods and services produced within the United States but consumed abroad. Imports are the reverse, right? So they're goods and services produced overseas but consumed within the United States. So they create these income flows, all right? So other examples, and we saw this just a moment ago in the side video, but positives and negatives here are trade deficits or trade surpluses, right? And so here in the graph below, this is from the FRED site, right? So Federal Reserve Economic Database, and they're pulling that data, as we can see at the bottom of that graph, from the Bureau of Economic Analysis, or the BEA. And so that's the value of the trade deficit through actually it looks like towards the end of 2018. If we were to show that for 2019 and into early 2020, we would find that graph is continuing its emergent downward trend there, and the trade deficit has actually gotten significantly worse in the last year and a half. Okay. One thing you'll notice is that the trade deficit actually seems to work inversely with the economy in general, right? So when the U.S. economy is doing well, say 2006, 2005, the trade deficit is quite bad. And when the economy does very poorly, as in the Great Recession, the trade deficit actually gets better. And there's a very simple reason for that, is that when the economy is good, we buy more stuff, and a good chunk of that stuff is foreign stuff. Okay? So if the U.S. economy is relatively good relative to the rest of the world, you know what? We buy more stuff than they buy of ours, and the trade deficit gets worse. If the rest of the world's economy is relatively good compared to ours, they buy more of our stuff and we buy less of their stuff, and the trade deficit gets better. Okay. So trade deficits don't correspond with good or bad in terms of local economy. They simply are a reflection of purchasing patterns. Okay. So how is it? We often hear things that very dramatic sort of things like, oh my gosh, trade deficit's gonna, it's a big problem, so on and so forth. And I'm not saying this is not a problem at all, but I would suggest to you it's not really a problem for the reasons that people advocate. The reason why we're able to consistently run a trade deficit in the United States since the mid-1970s is because the rest of the world is willing to continually invest in U.S. assets. Okay, so think about it like this. When you bought an imported good or service, I'm sure that this shirt was not made in the United States. When I purchased this many years ago, 1996, I think. When I purchased this, I paid in U.S. dollars, right? Even though let's say it was made in Malaysia, I don't know. I didn't pay in Malaysian ringgit. I paid in U.S. dollars. So what happens when we buy in imported goods is we end up with foreign entities essentially holding U.S. dollars. Okay, well, those U.S. dollars are only redeemable for U.S. goods and services. The Malaysian clothing company can't pay its workers in the dollars I gave it. It needs ringgit, right? It can buy stock in General Motors. It can buy U.S. federal debt. It could buy, Harley Davidsons, right? It could buy Chevys. It could buy GE medical equipment, right? With those dollars. Those are all U.S. production with output produced in U.S. dollars. Okay, right. So this is just walking through this purchase, right? Okay. So you can pause it if you need to. I'm not gonna stick around too much. Okay. So when we run these current account deficits where we buy foreign goods, we have the rest of the world effectively ending up holding U.S. dollars. So you might say, well, why would they want to hold U.S. dollars? Well, there's a lot of reasons why people would want to hold U.S. dollars. Here's a few of them here. If you want to buy U.S. goods and services, well, you need U.S. dollars. If you want to invest in U.S. assets, if you want to buy stock in General Electric, you need U.S. dollars, right? If you want to build a factory in the United States, you need U.S. dollars. If you need to pay U.S. taxes for whatever reason, you can't pay them in Canadian dollars. Give it a try sometime. It'll get no, don't do that. Okay, you got to pay in U.S. dollars. Doesn't matter if you're a Canadian business or if you're Toyota Motor Company. If you owe taxes to the United States government, you got to pay in U.S. dollars. People who want to travel in the United States, they have to hold U.S. dollars. I'm sure those of you who've been abroad, you can try to pay with your U.S. dollars when you're in France or something, or Australia, but yeah, it's not going to get you very far. Okay, so there's a lot of reasons to hold U.S. dollars. Okay, so this is getting us to the second of these accounts, the financial account. The financial account is a record of all multilateral asset transfers. Okay, so when entities buy and sell assets, right, the value of those assets, international entities buy and sell assets, the value of those assets is recorded in the financial account. So, for example, if at my house right now, if I were to sell my house to a Canadian citizen, the value of that house would be recorded on the financial account because now this house is owned by a foreign national, a Canadian citizen. Formerly, it was owned by a domestic national, me, I hold a U.S. passport. Now it's owned by a Canadian national. And so as a consequence, we have what? We have a Canadian individual investing in domestic assets. And that gets noted as a positive on the financial account. So when we have inbound investment into the United States, it's recorded as a positive on the financial account. When we have outbound investment recorded from the United States, it's a negative on the financial account. Now, whereas the current account was a measure of flows, right, income flows, the financial account as well as the capital account, which we'll get to in a little while, are measures of stocks, right? So they're stocks of value. So those are two different things. It's important to keep them distinct. Here I go through a little example of sort of, how these accounts ended up might be related, right? So we talked about importing a shirt a short while ago. Let's say we purchase. I go to the store. I go to the mall or something. It's not quarantine era. I go to the mall and buy a shirt, and I pay $20 for that shirt. Okay, well, of course I'm paying in U.S. dollars. So then what happens is we have $20 import, right? I'm creating $20 of outflowing income, but in providing my U.S. dollars, which they can't use in Malaysia, I now have a $20 overseas investment in U.S. dollars, right? It's in currency. Okay. And let's say that the company doesn't want the currency or doesn't need the currency for whatever reason, and so they choose to sell that currency and use it to buy treasury bills or U.S. government debt. Well, then we see a $20 sale of U.S. dollars denoted on the financial account, and then again a $20 overseas purchase of treasury bills. Okay, so the final transaction, the final end of the story ends up looking like, right, $20 negative on the current account, $20 positive on the financial account. If you're running a trade deficit, it under normal conditions implies a financial inflow. So if you're buying goods and services and providing liquidity or cash to the rest of the world, what is occurring, generally speaking, is that cash is returning to the country in the form of the investment in your domestic assets. So if you have a negative current account, you generally have a positive financial account. Okay. So to conclude our little story about the persistence of the U.S. trade deficit, the U.S. trade deficit can continue to exist because the rest of the world is more than willing to invest in various U.S. assets. Okay. All right, so moving on to the third of these, the capital account. It's very similar to the financial account, except for the difference is that we're talking about unilateral asset transfers. Okay, so what is that? Well, if we transfer a copyright or goodwill, right, if we have international debt forgiveness, if we have transfer of mineral or oil rights, anywhere where we're moving an asset out or moving an asset in but receiving nothing in return. Okay, this is a capital account transaction. So here are some pictures. The first one there on the left is the Panama Canal. The second one is a U.S. medical ship. And the third one is an oil right, it looks like in this case. So in those cases, in 1979, we give the Panama Canal back to the Panamanians, and of course we don't make them give us money for it, right? But of course it has value, and so it's an asset transfer, but unilateral. Okay. So if we take all three of those accounts, current plus financial plus capital, they should sum for zero for reasons that we talked about and we actually illustrated a short while ago. This is referred to as the balance of trade, and it also illustrates the idea that a trade deficit or a trade surplus does not imply that somebody hasn't paid for anything, right? So you'll hear people say things like, "Oh my gosh, we owe the Chinese or whomever all this money, right, because of our trade deficit." No. No, we don't. We don't. It's all paid for, right? When you went to Old Navy and bought that shirt from China, were you like, "Oh yeah, I'll pay you later, dude, for this"? Of course you paid for it, right? They don't let you out the door without paying for it. So trade deficit's paid for, right? Just means you've gotten more stuff and they got more income. Okay, but their income's in U.S. dollars, right? Has to come back. Okay, so hey, welcome back. So I was going to make this video a little longer and include some stuff about exchange rates, but I think that's plenty long enough. So I think we'll leave it there this time, and we'll make another separate video about exchange rates particularly. All right, have a good day, everybody. We'll see you then. Take care. Bye.